Okay, then now we calculated our free cash flow to the firm, as well as now we are in by the present value of all of these free cash flow to the firm. Then summation of these free cash flow to the firm, summation of free cash flow to the firm, technically we call as the enterprise value. Then enterprise value means the value available for all stakeholders, including equity and debt holders. That means this value is for the not only for the equity holders. This value is for both equity and debt holders. Therefore, from valuation perspective, this enterprise value is the value of the entire business, value of the entire business. But the final output should be, or the final output should be the for our equity shareholders. That means we need to identify the value available for equity shareholders. Then we call this as the equity value, value available for equity shareholders. Then how can we calculate the equity value? Then to derive the equity value, we need to do few adjustment to the enterprise value. Then we can derive the equity value. Then what are the adjustments that we need to do for that? Then as I told you, enterprise value is value available for all shareholders, all stakeholders, no, including debt and equity. That means this value is included with the debt holders value. Therefore, first thing is we need to remove the value of the debt holders. That means simply we need to remove the debt value from the enterprise value, because debt value is represent the value of the debt holders. No, therefore we need to remove the net debt value from the enterprise value. And as well, then if we have some cash in hand, then we can use this cash in hand to settle our debt holders. No, that means debt holders. Anytime we can settle, and then we can remove that, remove these debt holders from our business. No issue. Therefore, if we have cash in hand, then these cash in hand we can use to settle our debt. Therefore, when we remove the debtors value from our enterprise value, we remove it after deducting cash in hand from the debt value, because we assume then we can settle our debtors or the debt holders using our excess cash. Therefore, we deduct net debt from enterprise value. Then how can we calculate the net debt? Net debt, we can calculate net debt minus cash and cash equivalent. How can we calculate debt? Net debt minus cash and cash equivalent. Debt minus cash and cash equivalent. Okay, debt minus cash and cash equivalent. Then if it is a positive, we can say then we have debt holders. Then this debt holders value we need to remove from our enterprise value, because enterprise value it is included with the debt holders value. Then addition to the net debt, we need to do another adjustment for our enterprise value, because this enterprise value we derive it based on our operating activities, no, the cash flows that we can derive from our operating activities, but it is not included some of non-operating relevant things. Most relatable example is the excess cash. That means if we invest in the some in a company or the or not company, if we invest in the some short-term investment or the fixed deposit, then like that, like if we invest like these things, then we don't consider these things when we calculate the present value of the future cash flow. So the for our free cash flow calculation, we don't consider the like this excess cash investment in short-term deposit or investment in short-term treasury bond or whatever the things. Therefore, if we have like this excess cash, we need to add back this excess cash into the enterprise value, because this enterprise value it is not represent this excess cash, because this enterprise value is completely based on our cooperating activities relevant cash flows. It is not considered the excess cash that we invested in short-term investment or treasury bond. Therefore, if you have like this excess cash, not normal cash and cash equivalent, okay, then excess cash means the short-term investment in treasury bond. Like if you have like this, then we need to add back to the enterprise value, and then we can derive what? Then we can derive the equity value. Then we can derive the equity value. Okay, then after do this adjustment, then we can derive the equity value. Then equity value is the value available for whom? Value available for the equity holders. We can say it is the value available for equity holders. Okay, then here Okay. Then here we need to adjust net debt. That means we need to deduct net debt and add excess cash. Then how can we calculate net debt? Debt minus cash. Then what are the items that we need to identify as the debt and debt like items? Then main things the bank borrowing we can get as the debt, and lease the interest bearing borrowing, banks loans, lease. And also as per the valuation experts, normally if we have some uh, employee benefit obligations, that mean retirement benefit plans, these plans, that mean obligation also we can consider as the debt and debt like items. Okay, this is the practical scenario, and also most of the theory that I mean theoretical books also explain these retirement benefit obligations, employee benefit obligation also we can consider as a debt and debt like item. Okay, but commonly, bank borrowing and the lease, that means interest bearing borrowings, we can consider as the debt. From debt, we can deduct the cash. Cash means cash and cash equivalents. That means cash in hand, cash at bank. These things we can deduct. Then we can get what? Net debt. Then net debt we need to deduct from the enterprise value, and excess cash we need to add. Then we can deduct what? We can deduct the equity value. Then this equity value we can say as the value available for whom? Value available for the equity shareholders. And this is the end of our valuations. This is the final output of valuation, calculating the equity value. Then after dividing this equity value by the number of shares, then we can get what? Per share value. We can get the per share value. Okay, this is the process of valuation. This is the final output of the valuations. Okay, this is the we can say as the final output of the valuations. Okay, I hope all of you are clear with the calculation or the derived equity value from the enterprise value. Then I hope you can remember at the beginning point, I told you this, then I calculated, actually I have calculated this equity value based on the pre-cash flow to the firm. But I told you there are two cash flows, pre-cash flow to the firm and pre-cash flow to the equity. Then here I derive this business value based on the pre-cash flow to the firm. Then next I hope to discuss pre-cash flow to the equity. Then how can we derive the business value based on the pre-cash flow to the equity? But that way is not more popular or the more practical way to derive or the and more the popular way to derive the business value. Then practically also we normally use the free cash flow to the firm, but there are exceptional cases that we can use the free cash flow to the equity to derive the business value. Okay, then from next part I will explain you to how can we derive the business value using the free cash flow to the equity. Then I explained you what is the difference between the free cash flow to the firm and free cash flow to the equity. Then free cash flow to the firms mean free cash flows available for all shareholders for both equity and debt. Then free cash flow to the equity mean cash flows only for debt, cash flows only for the equity shareholders. Okay, then let's see based on the free cash flow to the equity business value derivation process.